Hello everyone. Kasim Khan is here. Please subscribe my channel and press bell button for more updates. Thank you so much, guys. Today we are going to discuss about the business taxes. Taxes is a very important concept in economics and finance as well because individual and businesses need to pay the taxes on their earnings, on their income. So it basically reduce your net income. So we will discuss in detail how the corporations pay the taxes and what kinds of their policies. And secondly, and the most important thing, every country have a own tax policy, and it vary country to country, and it totally depends upon where the organization is performing in which country. Like if we take an example of European countries, in European countries, taxes are very high. Like most of the countries are charging the tax bar more than 30%, and in Asian country taxes are low because just to attract more FDI, foreign direct investment. So here we discuss in detail how the taxation work in business structure. So both individual and the businesses must pay the taxes on income, the income of the sole proprietorship. Sole proprietorship basically is a form of the business in which the single owner, and the partnership is the form of the business where more than two owners own the business. Is taxed as the income of the individual owner. So their business, because their business income directly include in their individual in their personal income. So that's why their income taxed just one time, because the business income is directly added up in the personal income. So whereas the corporate income is subject to the corporate taxes. Corporations are the form of the business where owners are separated from the management. Secondly, corporation is a legal entity. They have a legal power. So that's why they have tax separately from their owner. So here is also a concept of double taxation we will discuss in the next slide. So whereas the corporate income is subject to corporate taxes, both individual and the businesses can earn two types of income. One is the ordinary income and the other one is capital gains income. So what is ordinary income, we will also discuss in the next slide. So under current tax law tax treatment of ordinary income and the capital gains income change frequently due to the frequently changing tax law. So over the time period, and most of the countries follow the democracy, and every 5 years government has been changed. So every government introduce new taxation policy, and they according to also depend on their country situation. If we talk about, like, let's suppose we talk about Pakistan, after the current government, like Imran Khan, they introduced a very high taxes rate in the Pakistan, and he is following the marginal taxation policy like European countries. So it totally depends upon where your organization is performing, where your company is performing, and what kind of the taxation policy has been followed. But these kind of policy frequently changes as it needed in that economy. So here is just a simple sample of the corporate tax rate schedule, how the corporate income has been taxed over the time period. Let's suppose if we take an example, here are the ranges of income. We can also say the band of income, that is from 0 to 50,000. On this income, there is no tax. And if the let's suppose base tax will be zero, and if let's suppose the company is have a 50,000 income, that their tax will be calculated on 15%. And obviously, if the company have a zero income, if the company is in loss, then no need to pay the tax. And if the income is above zero and below 50,000, their marginal tax rate will be 15%. And on that basis, we will calculate the total amount which the company need to pay in the form of tax. We look in the second bar of income, net income, that is 50,000 to 75,000, and the company need to pay 25%. Marginal tax rate will be 25%. If the company income lie between 75,000 to 100,000, the company will need to pay the 34%. So as you can see here, as their income is increasing, the tax marginal tax rate is also increasing. So this is very good policy, and most of the countries follow the marginal taxation. In this policy, the people who are more, they will pay more in the form of tax, and the people, the organization, the businesses who are less, they will pay taxes less. So most of the countries, like in Pakistan, we also follow the marginal taxation rate. And even if we take an example of many utilities firms like electricity, gas bill, they are mostly also fix their charges on the basis of marginal rate. So here are some other form of income. The one is ordinary income. What is ordinary income? Ordinary income is earned through the sale of firm goods or services and is taxed at the rate depicted in on below. So in ordinary income, that income you basically which you generate from your business, from the sale and purchase of your goods. So here for the calculation of business taxes, simply you multiply by your total amount which you earn with multiply by 0.39. So at the end you can calculate your taxed amount. So this is the basic form which most of the time individual and your sole proprietorship and the partnership form of the business use the ordinary income taxation policy. The other one is the most useful in the corporation, that is called marginal versus every tax rate. A marginal tax rate represents the rate at which additional income is taxed. Over the time period, businesses grow, their income is also grown with the passage of time. So, marginal tax rate divide the income in different slots in different bands. So, with the passage of time, when the every dollar will increase the income, ultimately it will tax it with different marginal rate. So the average tax rate is the firm taxes divided by the taxable income. Most of the time, some kinds of the businesses, some forms of the business, they charge less taxes to like to give more opportunities to expand that kind of business. Like in Pakistan, agriculture products, agriculture form of business are taxed low as comparative to industrial like textile and other kinds of form of the businesses. So in every tax rate, you simply divide the taxable income, the total income taxable income divided by the total income. In this way, you find the how much percentage you are paying. So here we can take a clear example. 39% is paid in marginal tax rate, and 32.3% is paid in the average tax rate. And let's suppose government say no, you need to pay the 35%. So they after this they will pay more with the 3%, and this way they will touch the minimum bar, and after that their income will be legal. So what is the interest and the dividend income? What are the benefit of these two things to the governments, sorry, to the business? Interest, interest is the cost, interest is the payments. Firms do the debt financing to expand, to grow, to fund their investments. So when on the debt financing, companies used to the pay interest payments. So interest is your cost. So before paying taxes, you deduct your interest expense, your interest expense, interest payments that ultimately benefit in interest tax calculation, because interest payments are your expense of the businesses, and it is deductible before paying taxes. So it gave benefit. And what is dividend income? Dividend, after total earning, after calculation of net income, after paying all kind of taxes, the remaining amount is called net income. After net income, there are the two options to the company. One is the company retained earning. The other one is dividend. The amount the company retain to meet future business obligation, to manage their future business operation, that is called retained earning. And the amount the company distribute among the shareholder, that is called dividend. So dividend is basically cash outflow. So your interest gave benefits in taxation, but dividend didn't pay you give a benefit, because dividend are paid after taxes, and interest payments are paid before taxes. So this actually moderates the effect of double taxation, which occurs when after tax corporate earnings are distributed as cash dividend to stockholders, who then must pay personal taxes on the dividend amount. So unlike dividend income, all interest income received is fully taxed. So if we talk about calculating taxes, corporation may deduct operating expenses and interest expense, but not dividend paid. So you can deduct your operating expenses and interest expense, but you can't dividend paid. This is creates a built-in tax advantage for using debt financing, as the following example will demonstrate. So that's why most of the time organization use debt financing because it gives benefits in tax because it gives benefit in taxation as comparative the, equity financing. So two companies that go here is the example from where we can explain two companies that go and no that go both expect in the coming year to have a EBIT, let's suppose 200,000 during the year. That co will have to pay 30,000 in the interest expense. No debt co has no debt and will pay no interest expenses. So here are the example. Let's suppose earning before interest and taxes. Debt could have a 200,000, no debt could have a 200,000, and both companies have a same earning before interest and taxes. So if we less the interest expense and debt corporation have a 30,000 interest and no debt corporation have a zero interest expense because it didn't take a debt. So earning before taxes, it has a 170,200. It is the same because it is a zero interest expense. And after taxation, its tax is 68,000 and it has a 80,000. Here is he is this organization is paying high amount as compared to those this and 12,000. The benefit this organization get that is just due to the interest payment. So earning after tax is 102 and 120,000, and just that is 80,000, 18,000. That difference is not as too much. Let's suppose this organization has to pay the taxes. So 18,000 difference is not a big difference, and this organization is getting benefits. That's why most of the time organizations go on the debt financing as compared to only on the equity financing, because debt financing gives you benefits in the taxation. So, as the example shows, the use of debt financing can increase your cash flow and earning per share and decreases taxes paid. So, debt financing will reduce your taxes which you need to pay in future. The tax deductibility of interest and other certain expenses reduce their actual after-tax cost to the profitable firm. So it is the non-deductibility of the dividends paid that result in double taxation under the corporate form of organization. So what is capital gain? Capital gain is also an important concept. Capital gain is the amount by which the sale price of an asset exceeds the asset purchase price. So when you invest in the company, you purchase a share of the company. With the passage of time, obviously the company will grow and it will expand. When the company will expand, so its asset will increase and your ownership will also increase on their asset. So with the passage of time, the rate at which the asset will grow, that is called capital gain. And capital gains also, obviously, it will directly add your net income, and it is also taxed as like ordinary income. So for corporation, capital gains are added to the ordinary income and taxed like ordinary income at the firm marginal tax rate, as before we mentioned in the previous slide. So it was all about how the organization businesses has been taxed over the time period. And thank you so much for listening to me. And thank you so much for watching the video. Take care, stay happy, stay blessed.